Hey guys, welcome to Aetherium Capital. Today I'll be discussing whether I want to add Louis Vuitton into my $550,000 long-term portfolio. So let's look at the analysis. So first of all, what you have to understand is that when you're investing in LVMH, you're not just investing in the main brand Louis Vuitton, which sells your handbags, your belts, etc. You're also investing into a bunch of other different brands that Louis Vuitton, Moet Hennessy actually owns. So some of these brands are actually brands that you could be very familiar with. You can see Rimowa over there, which is a suitcase brand. And the main brands are your Dior, Dom Perignon, Givenchy, Hennessy, Sephora, Grand Cru, Loro Piana, De Beers, etc. So as you notice, all of these companies over here, what they are is they are known as heritage companies. So heritage companies are companies with a long history, and they have a long track record of innovating and building things that has history embedded in it. So the disruption risk for LV is actually less significant compared to other products, such as your, for example, your Balenciaga, which is a new fashion and fast fashion trend. So LV's empire is basically on history and heritage, and it is actually not very prone to disruption risk. So let's look at the reasons why there's a decline. So first of all, LV has a significant exposure in China. It has benefited LV over the past 5 to 10 years due to Chinese growth. And currently, there's actually a slowdown in the Chinese economy. People are traveling less. They are buying less due to the economic downturn as well. And this over here is a cyclical risk. So what happens is that currently, because they have less purchasing power, they are not willing to spend on material goods as well. And what you can see in China currently is that there is actually a nationalistic sentiment where the Chinese people want to support their homemade brands and homemade brands instead of Western goods. So this could also contribute to the decline in the Chinese spending on LV products. Second of all, there's also a weakness in revenue and profit due to the cooldown from the boom in the fundamentals post-COVID. So during COVID-19, everyone is stuck at their homes. They have a lot of disposable income because they cannot spend at all. And what happens is that after COVID, everyone is going out to shop and they are spending more than they would spend if there wasn't COVID at all. So what happened is that there was this boom in the fundamentals and sales of LVMH, and due to this boom, obviously there's a bust currently, and LV's fundamentals are retracing and becoming more normalized. Thirdly, there's exposure in made in China for LV products. Basically, what you can see from this is that there's a lot of factories that are coming out and proclaiming that they are actually making products for Louis Vuitton. However, in reality, this is not true at all, because LV actually is countersuing these factories and saying that they are making baseless claims. So in my opinion, I believe that LV is definitely in the right here. And LV's products are most likely not made in China, because what LV and Bernard Arnault prides itself on is actually the quality, as well as the craftsmanship, as well as the history and heritage of their products. So they are actually definitely not producing in China. The only overseas plant, to my knowledge, is actually located in the United States of America. Now, fourthly, there's this tax issues in France. So this tax issues actually occurred over the past 1 or 2 weeks. What happens was basically France is trying to increase the corporate tax on LV, and it want LV to pay more tax to the French government. And what happened was that Bernard Arnault basically suggested that they will move production into the US instead of staying in France. And this actually created a huge uproar, and the media is basically reporting and shitting on Louis Vuitton right now. And this has also led to a decline in the stock price over the past 2-3 weeks. Lastly, you have a weakness in the worldwide economy. This obviously is cyclicality, and this is not a structural problem for Louis Vuitton. So now, let's look at the power of a name and why Bernard Arnault likes investing in this type of companies with heritage as well as history.
The first time, you are very young, but the first time I was in New York, it's in 71. And I remember the first time I arrived at Kennedy Airport, I took a cab. And at the time, the president of the US was Richard Nixon. By the way, they were devaluating the dollar during the summer where I was there. I bought dollars and my dollars went down. But I arrived at the airport and I started to talk to the cab driver, and he loved France. And he was interested in politics. So I asked him, and he did not like Nixon. So he was talking about that. He said, "You love France, so what do you know in France? Do you know the French president?" It was Mr. Pompidou at the time. Nobody here remembers. But he said, "No, I don't know the French president, but I know Christian Dior." And immediately, it struck me and showed that the name of Christian Dior is one of the, if not the most known all over the world in many countries. When I go to China, when I go everywhere, it's the name which is the most well known. So as far back as 71, I understood the power of a name. It's not enough, but I think it's one reason also. When by chance I was in contact with the real company, I think it's when I had the idea of doing.
Okay, so basically for those of you guys who have trouble listening to his French accent, what he basically said was that he went to a cab, the cab driver basically told him that the only thing in France that he knows is Christian Dior. So one of the main things that you can see over here is that the power of a name, regardless of whether you are in any country, you recognize the name. So this is actually the same as Coke. It doesn't matter whether you are in China, whether you are in India, everyone knows Coke, everyone knows McDonald's. Christian Dior has the same brand and the same power. So this over here, this interview was actually recorded by the Oxford Union over 9 years ago. And it's quite astounding if you look at the whole video. I highly recommend you do so if you're actually interested in this company. What you will notice is that a lot of things that he mentioned in this video, it actually played out over the 9 years. And it's absolutely amazing. Now, let's look at the second point. The second point, he basically said, what is a luxury company? And he defines a company. And he also compares between Apple as well as the products that he owns and the brands that he owns.
And would you say that Apple is now a luxury, or your definition, your improved definition of luxury, a company that...
Well, Apple is a fantastic company. And I happen to know Steve Jobs. And when he started the shops, he came to us to ask advice. And you can see many of these shops are not far from Louis Vuitton. Because he told me I would like advice and I would like to see if we can put Apple's shops in the same area of Louis Vuitton. And at that time, he was criticized enormously. Everybody thought it's completely crazy to sell Apple products in a shop. Because at that time, he was selling the Apple products only through wholesaler. Like, for instance, Dell. And I remember at the time, Michael Dell saying, it's completely crazy, it will never work. So that's an example of contrarian thinking that is working. So I was not helping, but advising a little bit. And I must say, I was myself a little doubtful of selling. At that time, it was not iPhone, it was the iPod product in the shops. But it was working. And we discussed the future. And I asked him, do you think, Steve, that your telephone is to answer your question about luxury? Your telephone is going to work as successfully in 20 years. And he said, I don't know, because there are some evolution and some newness and so on. And just to laugh with him, I told him, you know, that's the difference between us, because my Dom Perignon, I can guarantee you it will be sold and successful in 20 years. And that's also a luxury specificity. Luxury, one part of the products should be timeless. That's a paradox. To be successful, you have to have the combination between modernity and timelessness. And that's a combination that we try to keep, and to have a product from Louis Vuitton, which was started in the middle of the 19th century. Some products are the same for many years, but also they should represent the utmost modernity. That's the combination. And,
so basically what he mentioned over here is that the importance of a luxury company is something that blends timelessness as well as modernity. So luxury companies such as Louis Vuitton, you can see that it sells numerous products that have a history and a heritage. Some of the products that it's been selling for hundreds of years. And this blend between timelessness as well as modernity is actually what enables luxury companies to succeed in the long run. Now, let's look at the next point. So let's look at how Bernard Arnault invests and his thought process of investing and acquiring companies in the long run. This is extremely important, especially for investors as well, when we are thinking when to actually purchase stocks.
Personally, I think it's not unlikely that within the next few years there is a new crisis of a different type because of this amount of money, which is unbelievably high, and because of the level of debt of many countries. So we have to adapt. But also, when you have a crisis, we tried as a business manager of the group, of LVMH, to take advantage of it, because we have very little debt, and when the market is becoming to be less good, we can. In the past, we went through many crises. We are able to grow faster than the competition, and sometimes also it's a good period to find opportunities. But you have to be patient and try to avoid to invest when everything is too expensive. Because you see, people in the stock market, when it's going to grow fast, they try to buy. And on the opposite, when it's going down, the people try to sell faster and faster, which is strange. But it's good to be sometimes contrarian to that. It's not easy. It's not easy.
So over here, what you will notice is that what he is saying is exactly like someone like Warren Buffett. So Warren Buffett's main quote is basically be fearful when others are greedy and be greedy when others are fearful. So in this situation, what you can see is that Bernard's mindset is almost the same as your Warren Buffett's advice. So in my opinion, I believe that Bernard Arnault is extremely similar to Warren Buffett, and Warren Buffett prioritized in investment in energy, insurance and energy. Bernard Arnault prioritizes in your luxury sector. So Bernard Arnault is an amazing capital allocator, and this is something that I'm definitely one of the pluses of investing in Louis Vuitton.
Personally, yeah.
Now, the other thing that you can notice is that Bernard Arnault recently is actually buying a shit ton of shares. So over the past 90 days, he actually bought over 1 billion USD. For those of you guys who don't know, Bernard Arnault currently has a net worth of around 140 billion. So he basically essentially bought around 1% of his net worth into LVMH over the past 90 days. So now I want you guys to look at a few fundamentals and the numbers for the company. So one of the first things that we will have to look at is actually the CAGR of the markets. So the CAGR of the luxury goods market is probably around 6.6% estimated from 2025 to 2033. So what this means is that you can actually predict that Louis Vuitton's revenue growth will be around 7% every single year. Which is basically saying that it will track in line with the markets, even though I believe that it will be higher than that because LVMH produces a lot of good products as well as good brand equity. Let's just be conservative and say that it's in line with the markets at around 7%. So another thing that you can see for LVMH that is extremely impressive is actually the returns on equity. As a company that has almost zero debt, what you can see is that is in the high 20s, and even at the downturn currently, it is around 20%. So this high return on equity is absolutely amazing considering that LVMH has no debt and is actually a good sign of capital allocation and effective management. The other thing that is interesting for LVMH is if you look at the free cash flow yield currently, it's sitting at 5.5%, which across the past 10 years is actually the lowest. So what you can see currently is that it is, over the past 10 years, one of the cheapest times to buy LVMH based on a price to free cash flow basis. So LVMH over here is actually presenting a good opportunity to buy. It is attractively valued, and currently you can see that Bernard Arnault is also buying as well. So now let's look at the intrinsic valuation of the stock and what are the prices that I would enter at for the company. So first of all, to calculate the intrinsic value, what you have to understand, it is actually a discounted cash flow model that basically discounts the future value of cash flows to the present. So assuming the earnings per share actually remains at 5.38 and a growth rate of around 8% for the first 5 years, and the next 5 years to be 10%, and a terminal PE of 20, which is quite conservative for the base case, you will actually get an intrinsic value of around $107. So what this means over here is that if you buy LVMH currently at the current price, you would probably expect a return of around 10%. So obviously this intrinsic calculation actually excludes the possibility of a global recession. It also excludes the possibility of a huge run-up in the Chinese market. And obviously, that could be an extremely bear case and an extremely bull case. But as you can see, on average, with this conservative intrinsic valuation, LVMH is actually looking at a quite decent valuation right now. So let's end with this note over here. If you believe that LVMH in the future will be able to sell more products, it will remain as something that is desirable and valuable and something that people want to buy, what you should do is to ignore the economic cyclicality involved in the business. And what you should do is actually to focus on the ability for the management to consistently increase the desirability of their products. If you think that the management is able to do so, this decrease in the valuation and the decrease in fundamentals is actually making it a good time for you to buy into a brand equity that is extremely amazing. And in my opinion, I personally would be adding some Louis Vuitton, and when it drops to around $90 or $80, I'll be adding more. Louis Vuitton is a company that I would be willing to add 5% of my portfolio in it. And the reason for the 5% is I do not really like the fact that it still could be disrupted due to the risk that is actually highly dependent on fashion. As you can see, in recent years, people are actually moving into old-fashioned styles, which basically have minimalist designs and a lack of brandings and brands on the products. So this has actually significantly impacted Louis Vuitton's sales growth as well, because Louis Vuitton, the main brand, actually has a lot of logos, etc. However, the sub-brand, which is Loro Piana, has boomed recently, and the benefit of owning LV is that you have multiple brands with different strategies. You have brands that cater to the masses, such as your Louis Vuitton products, and you have brands that cater to the high-end and the rich people, such as Loro Piana, your Krug, etc. So this type of business, you can basically treat Arnold's Empire as an ETF, and it is a company that is extremely interesting with incredible branding power, and is currently at a valuation that is looking quite attractive. I hope you guys found this video useful, and if you did, do consider giving me a like and a subscribe, and I'll see you in the next one.